What was that tipping point where you thought that this is not for me? I am actually going to leave this and I'm going to start my entrepreneurship journey.
One thing that people think is risk has to be taken calculatively. I always believe take the risk and make it calculative.
He's a chartered accountant, he's an entrepreneur, and he runs his own consulting firm by the name of MI Capital Services. He's also a co-founder at Funding Possibilities and IVY Growth Partners.
So I've been a believer of doer. I've never been a thinker. That is why I think, after KPMG days, dealing with those clients who are making billion-dollar companies gave me the courage. Go out, make a company of myself, and then, be in the mud with people.
So Prateek, what are some of those things that separate unicorns versus the not so unicorns?
So it's the business life cycle. If the budgets are evolving for right time, we have the instinct that the founder is great, the product is great, revenue-wise they're doing great, they're nearing profitability, and they've achieved what they wanted to achieve in 3 years.
What are the reasons why some of the companies just do not go beyond a certain point and they eventually crumble and fail?
So one, because they get very pushy for raising capital. Too rapid a growth is also not great.
So I'm going to give you two options, this or that. One great co-founder or three decent ones.
3 decent ones.
Pitch deck or product demo. Hey everybody, welcome back to another episode of the CFO podcast. My guest today wears many hats, but he wears them all really well. He's a chartered accountant certified by the Institute of Chartered Accountants of India. He's an entrepreneur and he runs his own consulting firm by the name of MI Capital Services, which provides a range of services from incorporation all the way to M&A. Because of his keen interest in startup ecosystem, he's also a co-founder at Funding Possibilities and IVY Growth Partners. They are backing more than 100 startups, 2 of which are unicorns. He has been named as 40 under 40 CA business leader, and his firm, MI Capital Services, has featured on Forbes India. Now, if I keep listing down his credentials, I might run out of recording time. So, without further ado, let me introduce you to Prateek Tosniwal. Prateek, thank you for taking out time.
Thank you, Asad, for having me here. It's a great pleasure to discuss, the key important things that a lot of people think about, but end up not doing it. So thank you so much for having me.
100%. Prateek. So Prateek, today's episode is titled as Fundraising Lessons from a Serial Investor. I'm sure the startup ecosystem in UAE is thriving and there are a lot of founders who are thinking about how to navigate their fundraising, how to scale their startup. So that's the real value that I'm trying to extract out of this conversation today.
Excellent. I think, it's the need of the hour. We are moving from a paradigm shift of Silicon Valley to now UAE becoming one of the main hotspot for these tech founders to be and, call it as home. So I think this is a great session. I'll enjoy it, sure. And I hope the people also love the session.
Perfect, Prateek. So, Prateek, I generally start with some of the stories around the early life. Now, again, Prateek, you look really young. You are actually young, yet you have achieved so much. So what I would like to ask you is that what were some of those early days influences, some mentors, your parents, whatever it was that basically shaped you in the way you are and you've grown so much?
One thing that I learned is I don't want to be in a job industry. I wanted to take the risk because I saw my dad being a chartered accountant, leaving his family to start his own practice and take the courage to do that back in those days was not easy for a family like us.
Yeah.
But I think, that gave me courage. So my first inspiration was always my dad. I would not say that my mom was not an inspiration, but I'll tell you, both of them made sure that I lived the uncomfortable life to become comfortable later on in my life, right? So that's what they taught me. I've had few mentors throughout the journey. One of them was my CA mentor who said, becoming a CA is one thing, but implementing them is another, right? So he taught me to be there. Of course, I had, KPMG play a great part. I was in KPMG for 3.5 years. After that, it just clicked me. Probably job is not for me. I had to step out. I took the risk, ventured into startups. And one thing that I learned early was if you don't invest yourself, people don't care about it, right? It doesn't matter how much, knowledge you have. If you do not invest your hard-earned money, people don't take you seriously. So these were my early challenges And I think my first check I still remember was late 2017 when I invested, if I have to convert into dollar terms, $10,000. From there I started, and I think, I've done 100 plus companies today.
Wonderful, Prateek. This is nothing short of inspirational. But I think there's something interesting about this. So, generally, when somebody takes up the CA journey, the idea is, oh, I'm going to become a partner in this big four firm, or I'm going to become the CFO in such and such firm. I mean, this is generally the path that most of the CAs take, either it's India, Pakistan, Sri Lanka, or wherever else. And you've already touched upon it, but what was that tipping point where you thought that, no, this is not for me. I am actually going to leave this and I'm going to start my entrepreneurship journey. Some people are actually waiting for the right time. How are you able to find out this is the right time for me now?
So I always knew that, I had to probably go out of my way to build something. And one thing that people think is risk has to be taken calculatively. I always believe take the risk and make it calculative, right? I've always been the guy who followed Ratan Tata. He said, do something and make it right? So I've been a believer of doer. I've never been a thinker. And that is why I think, after KPMG days, dealing with those clients who are making billion-dollar companies gave me the courage actually to go out, make a company of myself, and then, be in the mud with people, probably running the company. And now I'm proud that, we've done like 85 deals from IV growth. We've done in personal capacities over 50 plus deals. I sit on board of 32 companies. I feel very, very good that I've taken that journey. Of course, there have been failures, but that's a part of the journey.
Amazing, amazing, super inspirational. And you mentioned about Ratan Tata. I mean, of course, his journey was very awe-inspiring as well. As a matter of fact, I was recently reading up on his project Tata Nano. I mean, it was a great project. I mean, even if you forget about the execution or the eventual outcome of that, but the idea of producing a car which is a very cheap value. I think it was $2,000 or 1,000,
Yeah, exactly.
1 lakh rupees, right?
Yeah.
That was the motto, right?
So it was like $1,200, $1,300.
Exactly.
And he said every house should have a car.
Exactly. And the idea conceptualized in his head when he was driving through, I don't know, a road or something, and it was raining, and he saw a family of 2 or 3 in a bike, and he was like, no, everybody deserves to have a car. Everybody needs to protect their family, and that's how it. So it's an amazing story of Ratan Tata. May God bless him. All right, Prateek, now that you already mentioned that you have invested over more than 100 startups in your capacity as a partner in IVV growth, as well as in your personal capacity, so you must have met a lot of founders, right? So Prateek, what is that thing that you notice right away in a founder to decide whether this is an investable startup or not?
So let me take you to a story where I met you, right? The moment I met you, I knew that you had a spark that wanted me to talk to you, right? So it's the person first who clicks, because that person is going to build the business. It's no one else, right? If the founders are crazy, right, and they talk about it passionately and they are dedicated to it, I think that drives me for all of my investments. I've always been a people investor. A lot of people talk about business. I'm sorry, when you're investing in early stage startups, there's no business, right? You're risking on or betting on the founder. And I think more often than not, if it is a journey that you are winning and driving with them, you need to handhold them, right? So it's the founder. Of course, it is the product that you want to, cater to the market. So for me, these are the two things that matter: people and product. For me, that is the bottom line. No matter what, I can talk about bank balances, his history, doesn't matter. A good founder can sell anything. An average founder cannot even sell good products. So that is what I've always believed.
Totally. I would take the first bit as a compliment. Thank you very much.
Pleasure.
And secondly, Prateek, so now you made a very important point. I'll take one step further, right? So it's, as you said, it's the people and the product. Absolutely right. And at that early stage, the pre-seed, when the product market fit is yet to be established, Prateek, do you look at some of the numbers? Do you assess something about, the financial feasibility, or it's too early at that stage?
So like you said, pre-seed, right? Exactly the time where I know at least there is some traction and there is some numbers. I am not saying that there is absolutely, I'm investing probably not at MVP level, right? So MVP is the stage where seed investors come in. I'm a guy who probably takes it to pre-series A. That journey between seed to pre-series A is where I invest, where at least I have some traction.
Yep.
And I know the founder has spent at least 6 months or a year, asking for capital. So yeah, for me, of course, some traction matters, but if it is a story that I can consume, because I love to become a consumer first for any investments that I've done, right? So if I become a consumer and my family is liking it, it doesn't take me more than 21 days to close a deal and just transfer the money. I don't care about, a lot of paperwork, because corporate governance at early stage is not even available.
100%.
So what will you do due diligence on? So,
No,
yeah.
agree. So you go by a lot of conviction and basically, as you call it, instinct, sorry.
Instinct, and of course the product that is there.
A product, of course. It has to make sense. Cool. Let's move from there, right? So now let's create a scenario, okay? Let's create a scene, visualize something. So now you've met at least 500 to 1,000 founders, given that you have invested in more than 100 companies, right? So having seen so many founders, what are some of the common mistakes that you see when they're pitching you their idea for the first time? What are the common pitfalls that you have noticed most commonly?
I think to start a few, one would be, they come always and they say, you're the best person for us, right? No one is the best person. You don't even know me, right? My LinkedIn profile is one bit, but you need to know me for judging that I'm the best person for your product. That's number one, because I firmly believed I can't be a master of all the segments, right? I can be good at fintech. I might not be good at agri-tech, right? So for me, if a founder is saying your capital will add value, I don't know on what basis they say it. So that's my first no, right? The second is when they say that, I've heard that your name is very credible and that is why, you should be there with us again. You're just trying to flatter me. But at the end of the day, your product is not making sense. The third is when they talk about a TAM and they're not aware of it, right? They probably talk about a TAM of a segment or a jurisdiction. They don't talk about the overall TAM, which is my problem. Last but not the least, if they're thinking only local. So if someone is thinking only local, I am generally not interested. If you allow me to add one more, I
Please.
generally don't invest in single founders
Okay.
because everyone has a life.
No, totally, and that's a topic that we would cover at some
So
point.
that's something that.
Okay, so that's very structured. So let's talk about. So you mentioned that there are quite a few things over here, right? So you mentioned they might flatter you, which comes across as ingenuine or not very natural. You mentioned about they don't know about their business, their addressable market, and all of that. So out of these things, I would share a small anecdote with you, Prateek, here. Exactly as you said. So there was one investor who was not investing in the jurisdiction where I operate or we operate. And he was very kind enough to say that, look, I love your business model and I would love to invest, but the fact of the matter is that I won't be able to help you beyond the check.
Correct.
And that's not what we want to bring on the table.
Correct.
Not only the check, but actually the insights, the advice, connecting you to people and helping you scale your business is the real objective of an investor.
Correct.
How far do you agree with this and how far do you apply this in your investing methodology?
So in my life, I've never been a broker, Asad. I've never just helped a startup to raise capital. If he's raising a capital, there will be some amount of check that goes from my pocket. So for me, what matters is if I can help the founder either in raising capital or in market access or in global, presence, whatever value I can add, I would love to do that rather than just writing a check and saying, boss, so many sequoias of the world are investing, let me also invest. I've never done that.
Okay.
Unfortunately, I'm not chasing sequoias and SoftBanks because they are giants, but they have a team that is sitting, right? They understand it. That's the first tick maybe. But I need to like the product. I have said so many no's to people who have sequoias.
Agree.
But because it was not a right fit for me.
100%.
So for me, like you said, a strategic investment is much more important than just writing a check.
100%. Now let's turn the tables. So now we've talked a lot from an investor perspective. Let's turn the tables. Think from a founder perspective, right? So from an early stage, sometimes you're really hungry for that capital. You have the appetite and all of that. You have the need. You have to support the burn. So as a founder, while you're capital hungry, you're not really seeing who are you getting invested with, right? Somebody said it, and Prateek, I don't know if you would agree. They said, startup investor is like that employee that you can't fire. So you hire very carefully. You can't fire them, right? You have to stay. So from a founder's angle, sometimes how would you advise them to think properly about their business in terms of the amount of money they're taking, they're raising, dilution, so that long-term what they're building stays with them rather than goes to investors?
Correct. So I have tried my hands on becoming a founder too. So
Okay.
I understand this. if you allow, in 30 seconds, I'll talk about my
Take your
startup
time.
that I wanted to. In India, it's a huge country, right?
Yes.
A lot of people travel from Delhi to Mumbai, Mumbai to Bangalore, Bangalore to Kolkata, and then go back to Delhi.
Yeah.
So there was me and my partner Shubhangi. We came up with an idea, why not we create Luggy Drop, which is called luggage drop, and we switch the luggage in your next destination, and the earlier luggage goes to your home destination, because you're traveling so much, you need changes, right, to your schedule. And we had a great idea, right? We were finding 4 or 5 young guys to do it. Unfortunately, I couldn't do it, and that is one of my failures too. But it's an idea that I loved, my wife loved. So as a founder, first thing you need to realize is when to raise the capital, right?
Yeah.
Because if you're just chasing capital and celebrate that capital, I'm sorry, you're not picking the right investors, because then you're just focusing on raising a capital.
Correct.
Right? Second is, even if you know your burn and the capital is only to survive the burn, right, and not for research and marketing and growth, then potentially I would again say that you need to go back and think your budgets again. Right? Third is, as a founder, I would rather bootstrap than dilute my equity to people. Initially, if it is a MVP or a pre-seed startup, I would want to raise capital who are strategic, because they will help me grow.
Yes.
Later on, a venture capital or a PE can come and take it up, right? It doesn't matter much. But at the initial level, for me, what matters is a strategic investors, and that is one point that I see. That, see, you're building a D2C brand. Who are the guys who've backed you till date? Do your cap table, or probably your investor or advisory board have people who belong to D2C. That's very important.
Agree.
So these are the points which is very important as a founder, I believe, and I've always chased that, right? So for me, that was very important. Go for them who are backing the right side of you. Just don't go for raising capital.
Agree. Something very important that you mentioned is go for investors who have sector specific knowledge, right? So there are many funds or investors who are like, oh, we are sector agnostic, we invest everywhere. But guess what? I mean, that comes with some limitations, right? They wouldn't have industry specific knowledge, those connections that can help you scale. So it's a very important point.
Correct.
I'll take one step back, zoom out for the benefit of some of those people who don't really know much about the startup world. So in like 60 seconds, can we define all those stages of fundraising for startup very quickly, like from pre-seed, what happens, and then how does it eventually sort of sail on its own?
Perfect. So I think the first stage is an idea, right? You can present an idea and raise a capital. That happens generally in the western part of the world. It doesn't happen anymore in the eastern part, right? But an idea, a paper idea, you can raise capital. That's till the level of incubation, right? Then you're building your MVP. Post-incubation comes acceleration, which is called a little bit just a step back to a seed capital, right? So seed capital is something that you raise generally from family and friends, or maybe the incubation center who backed you to build your product, right? Post-seed, there to a pre-series level, generally comes the angel investors, right? They will write $100,000 checks, $200,000 checks, and that is where you become ready for the market. You have traction, you have revenues, you have people who backing you. Then there are a lot of tech products who say, I've built tech, so I don't have revenue, but I have, so many customers using it, because you have to be free for some time. Then comes the venture capital world, which is pre-series A to pre-series A, right? And series A, B, C, and then the growth capital starts into a pre-IPO level. I think these, for me, bucket the cycle of a journey, but the investment journey is family and friends. The third I call it as fools, which is 3 Fs. Then comes your angel investors, then comes venture capital, and then you're bought out, or probably, have a PE or someone taking you out to the IPO level.
Sure. Although it was not planned, but naturally going into one discussion, which I was having with somebody very recently, how do you see VC versus PE? What kind of investment horizons do they have? How far along the journey are they ready to hold your hand? Because while one is quite patient, which is the earlier one, of course, the VC, PE comes with a different time horizon in their mind, and sometimes, instead of creating value, they sometimes destroy value as well.
Correct.
Do you see any pros and cons for a startup to take on VC versus PE?
So I feel if you do not go through a VC journey, you should not get a PE on board. Because VC, like you mentioned, probably is your patient and growth capital.
Yes.
They will irritate you, but at the same time, they're the people hand holding you throughout the journey.
Correct.
Right? So that 3 to 4 years of journey is very important because VCs understand that our life cycle is 5. So even if you see the funds, it's generally 5+1+1 or 7+1+1. Right? So they have a horizon of 7 to 9 years. When it comes to PE, the guys like, let's do M&A, let's go for pre-IPO, let's list yourself, let's double your money in 3 years. So probably you need to understand what check sizes you're raising, and if you've not gone through the VC journey, that's my personal choice. You should not take PE capital because PEs have a lot of money, but at the same time, they will drive you crazy to sell your business. Right, so that is your choice whether you want to sell your business or keep control.
I've worked with both now,
Of
and that's how I have the perspective of both. So both have their pros and cons. Why VC, of course, as you said, long journey, long time horizon, will hold your hand for a long time, patient, etc. While PEs bring their other advantages, of course, larger check size, much more corporate, much more sort of capital savvy and all of that. But at the same time, they come across sometimes as restless, as you said, M&A, do this, do that. Because again, they're under pressure to exit in a particular time frame. So we have to understand the incentive behind what they're coming with versus. But I like that point. You have the VC first and then transition into a PE. That looks like a good journey.
Correct.
Cool. Now
but I'll take a pause and ask you a question. How has your journey been? Because now you understand VC and PE. What are the insights you would want to give to people?
So both of them would be listening, so I have to be careful.
Of course. Of course.
So look, with PEs, so I worked for a company that was PE owned. And they actually brought me on board because they wanted to institutionalize the function. So the beauty of working with PE was that they were really engaged with you. Because I said restless, so we were doing, really fancy stuff like hedging, forex risk, and, not just, we had some debt capital on our balance sheets. So not just we were checking for covenants now, we were doing forecast covenant calculation. There was all kind of fancy models. So I got to learn a lot with them. They were really hands-on, at times too much hands-on. At times you would feel that they're micromanaging you. But it's just about how you perceive them, right? So they could be really hands-on. You get to learn a lot with them because, again, the kind of places they rub shoulders is different than VCs, right? They play at the different market. So that was the benefit of working with PE. At the same time, some of the extra micromanagement aspect was there. Maybe it was just specific to our case. Sometimes PEs have emotional attachment to a particular company that they've invested in, and that emotional attachment leads them to micromanage a little bit. While on other investment of theirs, they might be a little bit hands back and sort of managing in the other way. With VCs, I've found thus far, it's been 2 years, very, very, very good experience with VCs. They let you go about your business in the way they want to. They set a broad direction for you, broad strokes, They wouldn't micromanage you at all. Definitely, they would want to know some metrics, how you're growing, how you are tracking, how versus budget. But at the same time, they understand that this is a sailboat and not a oil tanker. You're going to continue changing your path as the waves comes along. So many a times we have changed our budgets. Our forecast keeps on changing, but they're not holding us to account on the previous one. Yes, they do ask what has changed, but they're quite accepting of the fact that things do change. So the way they perceive us is very different to the way PEs perceived us. And maybe that's to do with the maturity of the journey. Startups, again, very young, early stage. A more mature company is expected to do different things, and that's how PEs behave with them.
So if I have to, probably wrap this up in one line, the evolution journey should always be with VCs.
Yes.
And probably the exit journey should always be with PVs.
That is so right.
If that makes sense.
I think it does. Because the amount of returns that I've seen those Ps exiting their investment was phenomenal.
Correct.
The IPOs, secondary market sales, because again, they play in an entirely different market segment when it comes to exit. Good one. Prateek, so now we talked about how an investor look at founders. You told me how founders should look at investors. Now let's talk a little bit about valuation. So now you have an investor, and you have a founder who you want to invest in, and now they're bringing their financial model to you. Let's suppose they have a financial model, right? So what are some of the 2-3 top metrics that you really want to read in their financial model before you come up with a valuation of their business?
So, one, if they're just comparing themselves to other companies of the globe, that's a metrics that matters to me, because a lot of people say that in US this happened, in India this happened, and that is why in UAE this should be the multiple. I'm sorry, that doesn't work for me, because UAE as a market is a little smaller market compared to the other two giants, right? So that is a very critical factor. Second is the profitability. When are they eyeing profitability, right? A lot of startups just come with numbers. They say we'll become $1 trillion, or we'll reach this kind of revenues. But at the same time, when you go down and see the PAT, there is nothing, right? So I would not want to invest in such companies. A lot of people, again, to add there, they say that we'll be sitting on data. I said sitting on data is one thing, but you need to rationalize that data as well. So that is why it is very important. So I'm not saying probably initially 3 years, but in 5 to 6 years, if you're eyeing profitability, that's what second factor that matters. Third, for me, asset light, right? Very important. If you're not asset light, there's a huge chance that you'll be in the trap of capital, either debt or equity, whatever. So these are key financial metrics that matters. At last, probably ending up at marketing, because a lot of people just spend on marketing just to get customers, and they say it's a great strategy. Initial years, maybe, but later on it'll subsequently have to reduce, because if you do not have repeat customers, your product is not making sense. So for me, these are the initial key metrics that matters. A lot of people come with valuations, financial models, but they don't make sense to me, because they probably do not use how they eye their business 5 years down the line. They're just seeing other people and copy pasting it. But yeah, I've had great amount of models which I've seen where people actually put their numbers in right, to the point that they understand that my salaries will increase after a certain point of time, my tech will decrease because now tech is stable, all of that. So for me, critical matrix has to have a great model. And if I have to put a number, 6 out of 10 will not have great models. So yeah, 4 who have probably will be at a stage where either they are second time founders, or they have founders who are CFOs. A lot of people start with product. They don't have either the tech, or they don't have finance, or they don't have marketing, right? So if the 4 people, I would not say founders, but if these 4 key elements are not there, your model will never be perfect.
Interesting, Prateek. Prateek, you mentioned something important about profitability, and I know that comes from your DNA as a chartered accountant as well, because many people just ignore it. They want growth at all costs. So connecting this to the valuation point, Prateek, some founders, whatever I've spoken to, are really focused and attached to their top line. I just need to grow revenue. I just need to grow my TPV, the TAM, or whatever based on what you do, the GMV, gross merchandisable value, or the TPV in our world, which is total payments volume. They're just attached to that vanity number on the top, and they pretty much ignore everything else. And they think their valuation is based on that number on the top line. You as an investor, when such kind of comments or when such kind of discussions happen, what is your response?
I'll be honest, as I said, it's great to chase top line, because the initial 3 years, if you don't chase top line, it will not make sense. Your business will not grow. So capturing market is equally important. But at the same time, if you have repeat customers, if you have people who are using your platforms, lot of your other expenses will go off. And if you cannot value or clean in that time your expenses, you'll never become profitable. So for me, I have rejected companies really now sitting at $4 billion of valuation as well. But I know their valuation was 12 billion. Now they have reached 4 billion, right? So I've seen that journey. You are raising capital, great.
Yes.
Because you will have investors. Capital is available all over the market. Yes. Absolutely available, right? But what are you giving them back? Are you giving them anything in return other than burning, right? And so for me, if not 3 years, 5 years should be your kicker to get into profitability. If not, until and unless you're building like data centers or like quantum computing, which is like a 10 years journey, like a pharma something. But otherwise, if it is not hitting profitability in the 5th year, I think it's going to burn your capital to a level which, you will make money, but the others will lose, because I know founders create holding companies outside their jurisdiction to save taxes and pull out money. So,
But I think profitability is definitely important, but you're right. In the initial years, you need to capture the market. 100% agree with you. And on that note, Prateek, what I was thinking is that, we keep on giving examples like Amazon, for example, right? Amazon, I think, took 7 years to achieve break-even and profitability. So I think what I learned from what you said is that it's not one size fits all number of years. As you said, data centers building might have a different profitability, path to profitability, which is a very fancy way of saying that we are still
Correct.
loss making.
Correct.
And another business could have. But a usual benchmark is around 3 to 5 years is what when you expect them.
5 years.
5 years.
Just carrying your example, Amazon, Facebook, Uber is because people keep, challenging me. They didn't become profitable for like 10, 12 years. I say we didn't have the technology today that we have. Right? So you need to value the time also.
No, you're right.
As I said, data centers are not going to be profitable till 2040. I know that. But you're talking about today. And if you're building a healthcare, and if you're not profitable, if you're building a tech company, which is, from home, say, home-based tech companies, it has no cost.
No, you're
right. You don't have assets. So I'm talking about such companies where generally the life cycle is 5 years.
No, you're right. And I think you spoke rightly about Amazon, etc. I think there are very few companies, startups who were profitable from day one. I think
Correct.
Facebook is one of those examples, though. I was listening to this Acquired podcast, which I really like to follow. It's a very long form podcast, like lasts for like days, actually 3 hours or something. And Facebook from day one had Microsoft's ad inventory on their platform, and they were able to really monetize. So one of those outliers. But so working as a CFO in a startup myself, what I try to view this is that I'm not trying to become a spend police. I don't want to tie my company in the prison of frugality, yet we want to take growth bets, calculated bets, make investments which are basically going to grow your business while cutting out spend on all those unnecessary things which are just noise in the journey of our company. That's how we approach it.
Correct. And second thing that matters is how much founder is committed. Because for the initial years, I understand he's working for the company, so he'll have salaries.
Yes.
Right? But if salaries are going exorbitantly high for himself and the company is not profitable, then he's not committed because he's still making money.
Correct.
So all of these small little elements matters a lot.
Totally. Tie yourself to equity rather than salary, right? Incentives alignment. All right, cool. Now, let's move on to something which is very close to your heart. You are a very important part of the UAE startup ecosystem. You've been investing heavily in that, and you've seen a lot. So, are there some nuances to founders in UAE versus other founders in India or in the West in terms of raising capital, starting their startup? Do they start with some advantages over here because it's also sort of government supports startup initiatives a lot? So what are some of the nuances broadly in terms of anything?
So one thing you need to very well place rightly for UAE is it is the growth capital and the market that understands. It's a mature market compared to any other place, right? But the startup journey recently started. It's only been 2018 onwards when the startup journey really picked up in UAE, right? You see the Kareems, the Talabats, the Noons.
Correct.
They've just come like last a decade maybe, right?
Yeah.
Not more than that. So, and these are not new startups. These are copy-pasted startups, but they did well in this region because they implemented something that the region demanded.
Correct.
For me, what matters, and I've seen the growth in UAE, is a paradigm shift from just fintech and crypto-based economy to now, navigating and building very different like agriculture, health, AI. Focus has shifted, right? A lot of people are working on making UAE even a manufacturing hub.
Really?
So there are a lot of things that is going on, and that's because, like you said, government help and incentives. You present, a dream to them, they'll make sure it becomes true, right? That's their vision. Plus, it is a monarchy, right? You do not have to go with a lot of problems here. I believe the only thing that is lacking, if I have to put it that harshly, is capital markets. If capital markets comes in, startups who are growing big get the platform to list SME and then the IPO main boards, and then they can just grow from here.
No, you're right.
A lot of people recently asked me, there is a noise about UAE. Absolutely, because it's doing everything right. The world is affected from east to west, but at the same time, this country is offering golden visas. It's offering tech companies at $1,000. Which country allows you that, right?
100%.
Incentives. Government is giving you grants. You don't need anything else, right?
No.
All you need is good founders making good product, and they'll support you. I can give you examples of DIFCs and RACs and ADGMs, but what is valuable to see is the founders trusting this jurisdiction and the government backing them. And that is why this market is growing. And I think if the startups do it right, and if they find the capital markets to grow and evolve from here, I think the next 2-3 decades belong to UAE, and there'll be no stopping this country.
So true. And as you were saying this, something was developing in my head. Because we are talking about startups, it wouldn't be unfair to say that UAE itself is like a startup with amazing founders, super visionary, who were able to make phenomenal use of the capital they raise, an amazing business model, perfect marketing, exceptional customer service, and then of course the results are in front of us, right?
Correct. And I would say Dubai probably. If you have to learn marketing, learn from here.
100%.
Right? Like you said, UAE is, it's a startup. I say it's a company, and we have, our president who's driving it as a CEO of this country.
Totally.
I think we are not realizing where we are sitting,
Agree.
but give this 5 more years, people will envy that we came to UAE very early.
Cool. Amazing, Prateek. This was very good. So, Prateek, now we're talking about UAE startup ecosystem, right? Prateek, I want to know from you, based on your experience and understanding, what are some of the sectors which are now attracting more capital than others? You talked about there was a boom of fintech-based startups initially, and now you're seeing startups cropping up in every other sectors. So, which are some of the attractive sectors that are you seeing right now?
So I'm the most boring person to answer this because people talk about AI, tech everywhere around me. They talk about crypto, right? I think if I was in 2021, 22, these sectors, yes, growing, right? But I think briefly I've touched upon the sectors which I feel will be the game changers. It'll be data centers, right? It'll be cloud computing. It'll be quantum computing, right? Centers that we are thinking probably sectors 10 years down the line. Someone mentioned today, in fact, I met a very senior and he's like a mentor to me. He said something like, fusion electricity, right? Such sectors.
Fusion electricity? Okay.
Yeah, right.
I need to
I
open
don't know.
physics
I
again.
don't even know, where the world is moving. But we know that surgeries now is not conducted by humans, but by robots, right? So we are
Yeah.
already there,
Correct.
right?
Correct.
So we need to think 10 years down the line what will change.
100%.
So as much as we love ChatGPT today, we need to think what will be 10 years down the line ChatGPT.
Correct.
Right.
Correct.
So I think for me, the sectors that I am eyeing or I'm finding are probably, it's a capital intensive sectors, but I would love people who are building data centers, even for that matter, AI, but in education, healthcare, these are the advancements that we feel is going to change in the next half a decade to a decade.
Perfect. Perfect. Totally agree. I will move on further. I mean, to be honest, I was just looking at my watch and I was like, I think this podcast needed more than an hour because there's so much to unpack. Everything that you're saying is unpacking so much of value. So thank you again, Prateek.
Thank you so much, Asad.
Prateek, I would now go into some more deeper insights around fundraising. So now you're raising funds, you have the term sheet, and you have found your investor, the founder investor have sort of aligned on something. Let's talk about dilution, right? Now, all the early stage founders are not CAs. Even if they are CAs, they are not, sorry, even if they're not CAs, they're not, many of them do not have finance background. And rightly so. They have other creative skills, right? Many of them are not aware of dilution in real sense, right? So, first of all, I want you to explain what is dilution in easy words, and then why is it important for an early stage founder to think about it properly?
For me, dilution is finding right partners. Very simple. You have 100 shares. How can you get one partner at 5 shares or 10 shares, giving that equity? It's not easy because you're building that, you had that vision, you had the idea. So it's not easy to give away equity. But for me, that is dilution.
Yes.
Right. So that is dilution for me. Second, what was very important is you need to understand you need debt or you need equity. Because a lot of people mix this a lot, right? For me, if you're early stage founders and if you don't have different segment founders, co-founders, find them, give them equity. But maybe periodically, right? You can keep a benchmark or set a benchmark and then dilute equity. Or if you have like trust because he's a friend or it's a colleague, you can give equity from day one. But it's very important that you dilute it right. You don't want to be in a situation where you lose your voting rights and you realize after like 2 years, oh shit, what did I do?
You don't control your company.
Yeah, exactly. So for me, that's important. Second, don't chase capital.
100%.
Absolutely don't chase
100%.
capital. I've learned the hard way that if your company is right, don't have to go out of this room to find capital. They'll come to you. Right?
Yes.
They'll come to you. So don't chase capital, but at the same time, don't shy away in giving those 2% extra to strategic advisors who are adding value.
Yes.
Right. It's good to have Bollywood, Hollywood stars on your cap table. It looks very fancy, but are they really bringing that kind of growth to your company? If yes, please do give that 5% equity or keep that 5% equity. And last, what matters is the equity for your people who've been with you. Like we'll discuss this, probably, but I feel your company should have equal amount of equity kept for your people who are working from you, right, with you. And I think don't think about 2%, 3%, 5% if the growth is genuine.
Yes.
If it is genuine, don't worry about owning 50% of the company or like 40% of the company. I've seen founders carrying or thinking about, if I become $100 million, I'll my capital that is going out is $5 million. I said $100 million is a long way, right? Think about, if first you have to reach to $20 million, right? If you become $20 million, you're okay, right? $5 million here and there won't matter much. So dilute your equity for right people. If you don't find right people, don't dilute your equity. Very simple. Keep going.
Very well said, Prateek. Very well said. And Prateek, some of the things that I have been discussing or I've been advised by the board as I participate in some of those discussions is that, at times when you don't have that proof point, so for example, you have an idea, it's getting matured, but it's not yet there. You don't have the PMF, the product market fit yet. So try to bootstrap it as much as possible so that when you go for fundraise, you have a valuation big enough to be able to sustain whatever dilution is coming your way. Because let's suppose if I raise too early, so I don't have that proof point, and somebody comes into my cap table at that early stage, and I'm, though I could have funded it with my own money, I end up losing a lot of portion of my company, and the other party who's investing now gets the benefit because they have invested now at a very low valuation. So there is this balance between valuation versus the amount that you're raising. Just make sure that the amount of your valuation is, or it commensurates with the fund that you're raising, right?
Correct. And then probably if you want to safeguard that, you can use safe notes instead of deriving a value.
100%. That's a very good point. And would you also agree that in those safe terms, if you just have gotten the right valuation discount and the valuation cap, because those two things will just, of course,
exactly, because he's an investor. If I can raise, my company without any outside capital, I should not go for capital.
Exactly.
That's for sure.
Yes.
Right? But if I cannot, because I feel, if with my capital, I might not expedite to it 100 times, right? Then if you go out, raise capital, that capital should be linked to a right valuation as per the safe notes. Find the investor who's agreeing to that safe note terms, your cap, your discount, right? And then I'm sure that investor will get his lobby to invest for the future.
Yeah.
So it's good always.
Right. No, you're right. And Prateek, on this note, you mentioned about ESOP, employee stock options, very important point. The whole world basically works around incentives alignment, right? If you want to incentivize your employees to work hard, you need to attach their benefit to the value of your company. Correct. By giving them shares. Do you see founders who do not offer ESOP in the experience that you have had? If yes, how do you approach them? Do you educate them, or do you let them decide for their own company?
So I've invested in only Indian companies majorly for a large part of my career, right? In them, no one had actually heard about ESOPs till the longest of time, right? ESOP was a term that came after COVID, if I have to put it right.
Yes.
Right? Because till then, capital was very easily available. They were like, I'll hire, fire. But I think after a point of time, they realized that from their team members, they can make someone as co-founders. Right? So ESOP for me matters a lot. Or probably tying your people to the company some way or the other matters a lot.
Yeah.
Because you rather work with a team who's there with you from day one to your 10th year or 12th year than someone who's just changing and you're wasting time, because founders in their life are always busy raising capital. Right? I'm sorry to say that, but they're always busy raising capital. And if you do not tie your people, you will sooner or later realize the value of it. So for me, ESOPs is very important. Education, if I have to like correctly remember, it will be post 21 that we started giving education of ESOPs to a lot of startups. And I think today that is very critical from day one, that at least, if not more, 8 to 10% is kept for the employees.
Yes.
Right? And then you should give them benefits on when to utilize it, when not to utilize it. There's a lot of debate sometimes. Should it be yearly? Should it be quarterly? How, or 3 years? But I feel it should be flexible terms, keeping your employees always happy,
Yes.
but at the same time not losing control.
Yes.
Yeah.
Totally agree. And the classic that we see is 1 year cliff, 4 year vesting,
Correct.
right? Which
Correct.
is the most classic one. And at the same time, Prateek, what we have seen, of course, you would have seen more, is that people who have really made big out of startups as an employee are the ones who basically cash out on their ESOP. So it's absolutely the right
Correct.
thing to do, right?
Because that is your capital, which you use
100%.
for compounding later on in life.
100%. Prateek, at the same time, it's also a truth that many people who are not familiar with the startup ecosystem don't really understand what ESOP is.
Correct.
To be very frank with you, before joining a startup myself, I had a vague idea of how it works, but I didn't know the mechanics of that. So in like 90 seconds, would you want to very plainly explain how ESOPs work for employees? What does it actually mean to own equity, and how do you make money out of that?
So a lot of people, have this option where your salary, your average pay is say 100,000 dirhams, right? And you end up making 100,000 dirhams. But if you do a net calculation year on year, because say you hold 100 shares of a company, right, into the value of the share, you end up knowing that no, it's not 100,000 dirhams, it is actually 300,000 dirhams. That share into your multiple value of the shares that you have as a value will give you the actual value. Of course, you'll make money yearly if that is an option given to you, or after 4 years, like you mentioned, like 1 plus 3, right?
Yes.
After the fourth year, you get the exit option. So I have had founders who've compounded it. A lot of companies have now started even keeping the ESOP that they hold, like a gratuity that you hold, right, in S&Ps, which is money compounding, right? So a lot of people give you percentage. So provisionally, I should create that money for you because my employee is due for it. Not today.
It's like a funded ESOP.
It's like a funded ESOP, right?
Wow.
So you're making money on money. A lot of startup founders I have met now recently in the last 2 years who say, Prateek, think about it. I did not think it wisely earlier, but someone advised me, what if the employee leaves after 2 years for whatever reasons, right? I'm still liable to pay for the 2 years because my option agreement gives me him the right to claim for it. I said, perfectly fine, you're liable to pay. Then why not at least make him happy and allow him to come back after 6 months once his problem is solved, right? So they said, I create this as a provision. Once this provision is there, my finance team invests this into ETS, which is the least risky asset class, and I make money on money for these people, and that is why employees have not left me for 7 years. And that's a real life story. A lot of people do that.
Wow, this is basically you merge these concepts of ESOP as well as gratuity.
Correct.
You already alluded to that.
Correct.
But Prateek, I'll just unpack a little bit on this. Prateek, I thought the ESOP, the shares that you hold, I mean, as an employer, you're not liable to pay this.
Of course.
It's just that when somebody wants to buy it, they'll buy. I mean, you leave my company, you are a shareholder.
Correct.
Prateek will come to buy my company. I'll say, Prateek, by the way, you also buy the employee share. Prateek will buy it. So
it's like my gratuity that is compounding with you.
Yes.
I buy back.
Yes.
I buy back the shares.
Yes.
But I tell you, I'm not just buying back the shares, invested in S&P.
Exactly. So I'm saying it's a net benefit to the employee. All I'm trying to say is that in gratuity's case, employer is under an obligation to fund it because it's an obligation. When the employee leaves, Prateek has to take his gratuity along. In the case of shares, it's not an obligation, but he's doing you a favor. That's what you're telling me.
I'm telling you, that's what we have come to an era.
Wow.
Where people will only stick to you to think from that perspective. You cannot just say that, I'm not liable to pay, so I'm not paying you the ESOPs, right? So for me, ESOPs has now become like a provision in the balance sheet. If you can do it, excellent. People will trust you even more. That's like a trust factor, adding that trust layer.
Yeah, that is really on a high level of incentive alignment here. Prateek, really enjoying this talk thus far, running a little short of time, so moving quickly to the next section. Prateek, as we already mentioned in the intro, not that you've only invested in 100 plus startups, you've also seen 2 unicorns out of that. So Prateek, what are some of those things that separate unicorns versus the not so unicorn?
Correct. So it's the business life cycle. It's the budgets that they prepared, which you briefly covered, right? Your budgets keep evolving. If the budgets are evolving for right time, we have the instinct that the founder is great, the product is great, revenue wise, they're doing great, they're nearing profitability, and they've achieved what they wanted to achieve in 3 years, right? Those companies we generally hold on. The others we try and take an exit. Of course, we'll have failures because it's a part of the journey. But I'll be proud to say if I've invested in 100 companies, I've not written off more than 12, right?
Amazing.
So for me, because we have a good IC team, a very conservative IC team to say, I believe that it's very important to invest diversified and to make sure that you take the right exit, just not get greedy, right? So I've taken the right exits whenever possible. I've taken 8 exits, right, from the 42 companies that I've invested. So over a period of 6 years, I've taken 8 exits. Already out of it, 2 have become unicorns, and only because I could see everything right from what they predicted. Even now, I know my portfolio has 3 giant companies that will become unicorns, right? One of them is listing in SME. So there are only 3 things that helps me keep those shares. One, of course, is the founder.
Sure.
Second is the product, because the repeat ratio is high. You can see that a lot of production is, growing well, you're profitable and all of that. And third is, for me, team matters a lot, right? Who are the team? Have the co-founders changed? For some reason, are there any layers that is not available, right? Our due diligence happens every year, right? So I receive balance sheets from all the companies every year. Every 6 months, I try and speak to them. What, one way or the other, I'm just aligned to the companies. It's not like a passion or a passive investment for me. It's like an active involvement of mine. And that is why I've been very, very, very mindful in terms of, driving this failures of mine. And I learned from them that what did I do wrong in that investment that I made, right, to make sure that the future investments are fine. So in the unicorn journey, I just taste these 3 things which keeps me alive.
Amazing, amazing. Glad that you mentioned balance sheet, because most of the people just mention the P&L. So that is so important. I can totally understand how a CA investor looks like. Prateek, while we learn a lot of things from success, there's a whole new world that we learn from failures as well. So unicorns, successful startups, great stories, you must have seen failures as well, right? Not your failures, but the companies
A
who
lot of
failed.
failures.
What are the reasons why some of the companies just do not go beyond a certain point and they eventually crumble and fail?
So one, because they get very pushy for raising capital at all the time, right? They think that because 2 months of my sales have gone right, let's do that same strategy and spend on marketing, where they become bust. Third, people, very critical. The team just is nowhere in the picture. Fourth, too rapid a growth is also not great, right? It has to be calculative at some time, right? So too rapid a growth leads to failures. Fourth, of course, if there is a corporate governance failure where there is a siphon of money, all of that, and it happens, right?
Okay.
A person who's never seen a crore in his bank account sees rapidly 20 crores, right? He will think, I'm the millionaire, right? I
King
need
of
to
the
invest.
world.
Exactly. And those money, instead of going into the company, goes out somewhere.
Yeah.
So these are the critical factors that matters to me, that I have seen in failure stories. I am sure we've heard about a lot of stories from Indian startups that has gone, the other way. But one thing from an investor point of view, we become too judgmental very soon because of the stories that happen.
No,
Right?
totally.
Think about a portfolio of 10 companies, right? 2 are doing well, 6 are average, and 2 have actually disheartened you because you thought these founders will never betray you, right? I always tell people, there is no one that is yours forever.
Totally.
Never, even your family members, right? So please don't become so emotional about an investment that is just made. It's okay to have heartbreaks. You will learn from them. And that is why, as much as it is a personal decision to invest, I don't get emotional about my investments. I sleep over it, I don't think about it, I learn from it, and then it's a new day. So that's me.
So good. And hence the reason why you have all your hair black despite investing in more than 100 companies.
No, I still have
No,
white
this
hair,
is
but
good.
yeah, kind of yourself.
No, all good. So Prateek, you mentioned so many important points why startup failed. Um, overspending was one of them. I think one of them, which I have also seen in my limited capacity seeing startups, is lack of prioritization. Too many priorities at the same time. We want to do this, and by the way, this and this as well. So which just you end up doing nothing. What we try to make sure in our company is that we try to wear our pants one leg at a time, which just makes sure that, okay, we're going to do this and this and this, just to make sure that we stay on track. Prateek, this was such a value-adding conversation for me, and I'm sure for the audience as well. Again, thank you so very much. I know you're flying out tomorrow, early morning tomorrow, and then you still took out time for this. Thank you so much.
Thank you, Asad, for having me.
There is a last bit of fun thing that I do with people that is called the this or that quick fire.
I'm looking forward for it.
Yeah, okay, cool. So I'm going to give you two options, this or that, and you're going to tell me, okay, this or that, of course, right? Fundraise when you don't need it or wait until you must?
Wait until you must.
One great co-founder or three decent ones?
Three decent ones.
Pitch deck or product demo?
Pitch deck.
Term sheet in 48 hours or due diligence done properly?
Due diligence done properly.
Valuation discount or valuation cap?
Valuation cap.
All right. It's a good one. I like it. It's deep, actually. Deeper than what you were. Absolutely a good answer. Profitability with patience or growth at all costs?
Profitability with patience.
Perfect, Prateek. Good stuff. Enjoyed chatting to you, Prateek. Is there any message that you want to leave founders, investors with? They're listening to you.
I never thought that from a CA background I'll become an entrepreneur, but keep taking calculative risk in life. I took a flight, came to UAE, not knowing a lot of people. I just had myself, my degree, and Cecil Soni, who's my partner today. But I think because we hustled along together, we trusted each other. We are sitting together with a 60-member team now. So it's about the risk that you take. It's about the flight that you take sometimes, that can yield results. It may not yield results at time, but learn from it and go for it. As I always say, I love the Nike story. Just do it.
Totally. Just do it. All right, ladies and gentlemen, I hope you enjoyed today's episode. For me, meeting Prateek was nothing short of being fortunate. He's just a dose of motivation and inspiration for me, and I'm sure for you all as well. He's quite active on LinkedIn as well. He has an Instagram handle. I would encourage you to follow him. Until next time, take care. Cheers.